Hey, welcome. Today we are pulling back the curtain on one of the most fundamental mechanics in private equity, the capital call. Now, on the surface, it just sounds like a simple request for money, right? But for the huge players, the pension funds, the university endowments that really fuel this industry, it's way more than that. It's a really complex process that's tied to legal duties, accountability, and a whole lot of trust. We're going to break down why the details in that simple request are actually everything.
So, let me ask you this. How do you go about investing millions or even billions of dollars into a fund, but you only hand over the cash when they specifically ask for it? I mean, this isn't about wiring a massive lump sum up front. No, this whole world is built on a promise, a special kind of commitment that really is the bedrock of private equity investing.
And that promise has a name. It's called a capital commitment. So when you sign on as a limited partner or an LP, you're not cutting a check for the full amount right then and there. What you're actually doing is making an agreement, a legal promise, to provide that money when the fund managers, the general partners or GPs, find a great investment opportunity. This is brilliant because it lets you keep your money working for you somewhere else until the absolute last second it's needed.
Okay, so the moment arrives. The GP finds that amazing company they want to invest in. That's when they trigger a capital call, which you'll also hear called the drawdown. This is the official request. It's the fund saying, all right, it's time to turn that promise into actual cash so we can go out and close this deal.
Let's make this super simple with an example. Imagine you commit $100,000. As you can see here, maybe you pay an initial $20 grand. That leaves $80,000 as your unfunded portion. Now, over the next several years, the fund will call for pieces of that $80,000 as they buy into new companies. Every time they do, your total amount invested goes up, bit by bit.
So, what's actually in that capital call notice when it hits your inbox? Well, at its most basic, it's pretty straightforward. It's going to have the fund's name, the due date, and that's usually pretty quick, like 7 to 10 days, your total commitment size, the exact percentage of your unfunded capital they need now, and, of course, the wire instructions.
Seems easy enough, doesn't it? You get the notice, you send the money. Simple. But what happens when the stakes get a whole lot higher? What if you aren't just managing your own portfolio? What if you're managing money for thousands of teachers or for a university's future? Well, that's when the entire game changes.
And that's exactly where an organization like the Institutional Limited Partners Association, or ILPA, steps in. They've created a whole framework of best practices. Why? Because for these big institutional LPs, a simple notice with just a few lines of text, it doesn't even come close to cutting it. They're held to a much, much higher standard. Now check out this quote from ILPA, and pay close attention to that first word, fiduciaries. This single word is the key to this whole thing. See, institutional investors aren't just business partners. They have a legal and an ethical duty to protect the people whose money they're managing. Being a fiduciary means you have to watch that capital like a hawk. You are accountable to all these different groups, boards, trustees, risk departments, and they all need to know exactly how every single dollar is being used. So a basic notice with just an amount and a due date? Nope, not gonna fly. What they need, above all else, is transparency. So how do you get that transparency? Well, ILPA lays it out pretty clearly. A really effective notice needs 3 key parts. First, a cover letter, which is just a quick summary. Second, a much more detailed description letter. And third, and this is crucial, a standardized template for all the nitty-gritty accounting details. That description letter, that's where the real story is told. It has to answer all the questions that a responsible LP would be asking. You know, if it's for a new company, who are they? What's the plan here? Is this a buyout, a growth investment? And if the call is for fees or expenses, they need to see the math. How is it calculated? What exactly are we paying for? The goal of all of this is just total, crystal clear transparency. It's about giving the LP the tools they need to do their job as a fiduciary. They have to be able to look at that notice and see exactly where their capital is going and make sure it all lines up with the fund's strategy and their legal agreements. And this standardized template? This is where the rubber really meets the road for the accountants. It has to clearly spell out the LP's financial position before this transaction and after. It tracks things like their unfunded commitment, how much they've contributed to date, and even details on the management fees and the waterfall. That's the complex formula for how the GP gets their share of the profits. Of course, investing isn't a one-way street. LPs put money in, but eventually they expect to get it back, hopefully with a nice profit. And that happens through something called a distribution. This is when cash or stock is sent back to the investors after a big success, like selling a company or taking it public. Now hang on, because there's a really critical detail here that can be a little tricky. A distribution isn't always just free and clear money. It can be split into two parts, non-recallable and recallable. Non-recallable is yours. You can take it to the bank. But recallable capital is money that the fund can actually ask for again later on. And here's the wild part. That means a recallable distribution actually increases your remaining unfunded commitment.
Let's jump back to our example to see how this works. Remember that $80,000 unfunded commitment we had? Well, imagine the fund sends you a distribution, but $10,000 of it is labeled recallable. That $10,000 gets added right back to your unfunded pile. So suddenly, you don't owe $80,000 anymore. Your commitment is back up to $90,000. It's a super important detail for any LP trying to manage their cash flow.
So after all that, you might be thinking, wow, this is a lot of work. So why bother with all these detailed standardized notices? Well, the payoff is actually huge for everyone involved. It makes processing so much faster, it lowers the cost of monitoring these investments, and it cuts way down on all the back and forth emails. It just makes the whole industry run a lot smoother. And really, all this talk about efficiency and details, it's all in service of something much bigger. This isn't just about shuffling paperwork around more effectively. It's about building a rock-solid, transparent relationship between the investors and the fund managers. It's about creating a foundation of absolute clarity and trust, which you have to have for a partnership like this to work for years and years.
And in the end, it all boils down to this one powerful idea from ILPA. The whole point of all these rules and best practices is to empower the limited partner, the fiduciary, to do their job, to give them what they need to accurately interpret, account for, and monitor every single transaction. So next time you hear about a capital call, just remember, it's not just a request for money. It's a critical moment of trust and transparency that makes the entire world of private equity go round.